The information presented in this video is general in nature and does not constitute personal advice. I am not a financial advisor, and the information has been prepared without taking into account your personal objectives. You can read my full disclaimer in the description below. A share is a percentage of ownership in a company or a financial asset. If you invest in shares of a company or financial asset, then that makes you a shareholder. To illustrate this, I'm going to use a very simplified example. Let's say that a business offers 10 shares and you, as an investor, purchase one of those shares. As a result of this purchase, you become a shareholder of this company and own 10% of the business. Meet Mike. Mike is the owner of a company and has been doing quite well. Mike has big ideas and wishes to expand the company but does not have enough money to cover the projected costs of these ideas. Rather than taking out a loan and being in debt, Mike decides to raise money to finance his company instead. Mike can do this by what is called going public. Simply put, Mike lists his company on a stock exchange. Although Mike's intent is to expand his company, other reasons companies may wish to go public could include to fund research and development or to pay off debt. A stock exchange is like any other marketplace you might already be aware of. It's a place where products are bought and sold. A stock exchange is no different, however, it is specific to financial securities. Stock exchanges exist all over the world. Some examples are the Australian Securities Exchange, New York Stock Exchange, Hong Kong Stock Exchange, and the London Stock Exchange. When a company is listed on a stock exchange, it means that a company can raise equity capital in exchange for issuing shares to investors. Being a shareholder comes with certain rights and benefits. Some of these may include access to reports or information, participation rights in general meetings, opportunities to purchase additional shares on issue, dividends and dividend reinvesting plans. Whilst there are many benefits to becoming a shareholder of a company, being a shareholder also comes with an element of risk. There are many factors which influence a company's share price to rise and fall. If you sell a share at a price higher than what you bought it at, then you will have made a capital gain. Conversely, if you sell a share at a price lower than what you bought it at, then you will have incurred a capital loss. All investors must bear in mind that in some instances, a company's share value can fall to zero. Volatility, as defined in the stock market, relates to the degree of variation of a share price. If the value of a security does not fluctuate dramatically, then it is regarded to have lower volatility. Conversely, if the value of a security changes rapidly and unpredictably, then it is regarded as being higher in volatility. Some securities are more volatile than others, however, all securities fluctuate in value. Volatility can influence shareholders because it creates an emotional response, both from the perspective of buying and selling. A misconception, particularly in new investors, is that their entry and exit from the market can be timed. However, one of the most important lessons to understand is that the market is unpredictable. A common belief amongst investors is that rather than timing the market, being successful is about time in the market. As Warren Buffett, one of the most successful investors of all time, quotes, "Our favorite holding period is forever." Thank you for watching. Until next week.